Hello traders, in today's video I'm about to share with you the missing piece, because when I realized this, when I saw this, it really improved my directional bias. And I'm sure most of you struggle with determining the direction to trade within a session from the New York, London and even the Asian session. In this video I'm going to share with you a strategy not created by me. Credit goes to the master, and I'm going to use both the master and ICT concept to demonstrate what I'm about to show you. So all you need to do is to backtest the strategy. According to the master, this strategy gives 88% probability on any entry model you apply, be it SMC, be it supply and demand, or whatever it is. So without wasting time, let's dive in. So this strategy requires the 5-minute time frame, okay, and it is called the defining range and the implied defining range. To implement this strategy, you need the 5 minutes time frame, because you are going to label or annotate some things on the 5-minute time frame, and this time frame is between the 9:30 a.m. New York time to 10:30 a.m. New York time, because I'm about to share with you the defining range, which only applies within the New York session, meaning from 9:30 a.m. till 4 p.m. So you are going to be looking at entry signal within 9:30 a.m. and what? 4 p.m. So what you need to do first is to, within that 9:30 a.m. to 10:30 a.m., you are going to draw a box, okay, like this. You're going to draw a box from 9:30 to 10:30, just 1 hour window. That's all you need. Then from there, you are going to mark out the wick, the highest point within that time window, and the lowest point. In this case, the highest point is this wick here, and the lowest point is this wick here within this window, okay. Then you are going to draw a line, horizontal line, above and below, okay, touching that wick. Now, once you do that, that distance from here to this place, from the high and the low, is called the defining range, or DR, okay. Now, what you need to do again is this. You are going to mark out the body, the highest body close or open. In this case, this is close, the highest body close and the lowest body close within that time frame between 9:30 and 10:30. You are going to mark out that distance, okay, and you call it what? The implied defining range, or IDR. Now, this is very important. Listen, once you draw out your DR levels and your IDR levels, what you need to do now is to monitor price within these levels here, this high and low. If price closes above the implied, this red line here, if price closes above the implied, this is an early indication that price wants to go higher, and this, the low here, becomes the low of the session, okay. This becomes the low of the session. Till the New York session closes, price should not take out this low, okay. And this strategy is being applied, according to master, on the S&P 500 evening contract, futures contract, okay. But he also said that it can be used on forex, on gold, any financial asset, okay. I have been testing it on forex and gold for some time now, and it is excellent. It's doing a very good job. So now, when price closes above here, what you need to do, for example, if this was what we are seeing, you can see that here we have what? ICT fair value gap. You can wait for price to come below, either at a discount level or at equilibrium, wait for price to come in, take your entry, and then you target the next liquidity point. Okay. From my experience, you start with the low hanging fruit. Okay. Look for 2 to 3 hour trades. Now, what I don't want to see is a week. Price goes up here and closes below. This does not fit in. This does not fit into the rule. Okay. We only need a body close above this line. Now, above the implied simply means is an early indication and you can start what? Looking for trade. If price closes below, okay, if price closes below the implied IDR, is an early indication that throughout that New York session, this will be the high of that session. Okay, this will be the high of the session, and you don't expect price to take out that high. Okay, so what you need to do is to look for short entry, short trade what signal. For example, you can use the ICT fair value gap as your entry. Okay, price trade back in here with stop loss above. You can target either the low here or the next hanging fruit, and mostly go for 2 to 3 hours if you want to be safe. This can lead to 6 hour, 7 hour trade. I will show you from the examples. Okay. Now, your question is, what about this black line, the defined range? If price closes above the defined range, okay, this is a strong indication that throughout that New York session, you should be looking for longs. Okay, look for longs for your directional buyers. You can wait for price to tap into your ICT or any entry model you wish to use. I'll be sharing with you some ICT entry model where you can use in entry and then you target either the high and then the low hanging fruit and take partials along the way. This can give you minimum of 2 to 3 hour trades, and you can let the rest run for more profit taking. Okay, what you don't want to see is a close below. You don't want to see price close below. If this happens, this does not go for the rule. Okay, if this happens, it does not go for the rule. So you only wait for price to close above. I'm going to share more videos with a situation like this. If price takes the wick, okay, and then close back in, there are ways you can enter this packet, and probably you look for short. So this is not my concept. I give credit to the master. You can follow him on Twitter and also here on YouTube. Make sure you go subscribe to his channel because he has great video over there. Okay, so now if price closes below the defined range, okay, then you'll be looking for what? Ways to short, and this will be the high of the session. Okay, this will be the high of the session. So when price trades back in, you don't need to be afraid. You can take your trade, okay, and then target the low or any low hanging fruit in terms of liquidity. Remember, in this channel I keep telling you why you take your profit at liquidity levels. Okay, take your profit at liquidity levels, and then you allow the rest to run to maximize your what? Trade. Now, I want to clear things up. This is not an holy grail. You need to back test. Okay, do your own research, and then you will see that this really works. This is an eye opener for you. This will be an eye opener for you because it is for me. It makes it easier to simply know which direction you can go, you can trade within a trading session. Okay, so let's look at examples. This was a trade I took on the 13th of December, okay, just yesterday, as at when I'm recording this video. Now, before you go on, the master said that this strategy, you may not trade it during high impact news releases like FOMC, CPI, or interest rate decision. Okay, but from my testing, however, I said you can try, but the probability will be lower. Your win rate will be lower, and I think it's right because he has already done a lot of back testing of data from over, I think, over 7 years or so. So now this is the US 100. Okay, from the time window here. Now what I do is I simply convert, because I live in Nigeria, so this is 15:30, which is 9:30 New York time. Okay, you can simply go to Google, type 9:30 a.m. New York time in, you put your country or your time zone. It will tell you your local time, and you can simply put it here, or you change your time zone here to New York. Okay, but I don't do that. I leave it at Nigerian time. I only convert this to my local time. And also there's an indicator here. The indicator is DR IDR V1 by the master. You can just get the indicator and then it will plot things out for you without you marking out those levels manually. So you can see this is the New York session. After the news release, there was a news release yesterday. After that news release, the CPI, the 9:30 session begins. So all you need to do is to wait. You wait until the session is over. Now, what are you looking for? You are looking for a close above the implied or the DR level, the IDR or DR, or a close below IDR or DR. Now, in this case, you can see the market closes below. The market closes below, so that means you need to be looking for what? Shorting opportunity. The immediately market closed below and traced back to this level, I took my entry here. Okay, I took my entry here, and then stop loss above this. This is the fair value gap, because most times I'd like taking my entry at the supply zone or the ICT fair value gap. But in this case, it didn't get to the fair value gap. Yeah, it didn't get there. But however, since I know that the market will be heading down, I protected myself by putting my stop loss above the fair value gap. Okay, just here, the next candle above it. Okay, so that way, giving me a good risk to reward. Took my entry at this level at the IDR. Okay, short, stop loss here, and then I just simply aim lower to the next level. I'll talk about all this in my later video. Okay, that'll give a quick 1 to 2 hour trade. Okay, 1 to 2 hour trade. Also on gold, that same day on gold. So that same day on gold, okay, this is the same time, 5:30 window to 9:30 a.m. New York time and 10:30 a.m. New York time. But in my own chart is printed in my own time zone. Okay, so all you need to do is to wait for price to close either above or below the IDR or the DR level. Now in this case, you can see prices close below. Because price closed below, you simply, there's a fair value gap up here. I took my entry here, short position. Immediately after this liquidity was taken. Okay. And then stop loss above the fair value gap, ICT fair value gap. And then I aimed for the lows, okay, for just a 1 to 2 hour trade. Because I was back testing this, I decided to use it on live account. So now you can see the price went, I came low. Till the end of the New York session, this was the high of the day. Okay, you can do this, you can back test. There are other examples I can share with you here. Now this is another example on gold. Now if you can see here, at the end of that session, on that time window, price closes below. This time around, traded into ICT fair value gap here. So credit to ICT. I'm going to link the link to ICT content. You can watch his entire YouTube mentorship program 2022. Also follow him if you have not, and then give them a shout out. Okay, they did well for revealing this to the general public trading community to trade from. So immediately price came to the fair value gap. That was the entry. stop loss above. Okay, and so you can aim lower. Okay, in this case, giving you a 1 to 8 risk to reward. See, beautiful, beautiful, beautiful entries. Yeah, you see. Now this is a bullish scenario. Price closes above the level here, came back down to this demand zone here. You can enter the trade here with stop loss below. Okay, is either you put your stop loss below here or below the mid level. Okay, stop loss can be here. You enter, immediately price fill this up. Then you target probably this level. Okay, for a quick 1 to 2, 5 trade. Now, all you need to do, why I'm sharing this is because this is game changing. So this is one beautiful strategy you can apply immediately. Make sure you backtest. Price came in here and then went back down. So try it out on, it also works on Forex. Maybe in my next video on this, I'm going to talk about some of the trades I took on Forex. So shout out to the master, shout out to ICT. ICT stands for Inner Circle Trader. Go to his, I will keep the link in the description. Go to their YouTube channel, show them love, and then I will see you in this video.